Welcome back to the deep dive. Today we're taking on an incredibly dense investment report, and, well, we're going to distill it down for you.
We are. We're looking at one of the giants of American insurance, the Allstate Corporation, ticker AL.
And our mission today is pretty specific. We're dissecting a thesis that argues Allstate is at a major inflection point.
Right, and that it's fundamentally mispriced by the market. So our job is to look past the headline numbers and really figure out if this recent success they've had is, a durable structural shift or just...
Or just a high point in the cycle that's about to come crashing down.
Exactly.
Okay, so let's get right into that core paradox. Allstate, for as long as I can remember, was the definition of a legacy insurer. High-cost, captive agents, huge offices.
A real behemoth.
Right, and they went through this incredibly painful overhaul, this transformative growth strategy to shed all that baggage. But when you look at the stock price...
The market just doesn't seem to care.
It's still pricing Allstate like it's that old, slow, low-growth company. It's basically priced for failure, or at least for reversion to the mean.
And that's the tension. That's what you, the investor, need to wrestle with. Is the market skepticism justified? Because the numbers, the numbers they just posted completely defy that story.
Let's put a number on it.
We're talking about a company that hit an exceptional 34.7% return on equity. That's for the trailing 12 months ended September 2025.
34.7%. That's not just good for the P&C industry. That's an absolutely elite figure.
It's top of the class.
But here's my first question, my immediate challenge. ROE can be a lagging indicator, right? It can be juiced by one-offs. So what actually fueled that number, and how do we know it's not just a sugar rush?
That's the key question. And the ROE was fueled by two really powerful engines firing at the same time. First, they finally got their underwriting profitability back. Their core business started making money again. And second, they got this huge tailwind from record investment income, thanks to the high interest rate environment. Our source material today is, it's exhaustive. It covers everything from their competitive positioning against Progressive and Geico, all the way down to the nitty-gritty of their catastrophe reinsurance.
So we're going to hunt for proof that this dual engine can actually keep running. All right, let's start with the narrative here. This whole deep dive has to begin with the sheer scale of this internal shift. This wasn't just tweaking a few things.
No, not at all. This was a fundamental move away from that high-cost captive agent model.
Toward what? A low-cost, digital-first insurer?
Exactly. Something that could actually survive and compete in the 21st century. The source material calls it the necessary pain of transformative growth.
And I think that word necessary is so important. Their old model, with its huge cost structure supporting thousands of agencies and all that real estate, it just couldn't compete anymore.
It couldn't. Not with the low-cost models of, say, a Geico or a Progressive. The goal was almost existential. They had to slash their expense ratio to have any hope of being competitive on price.
And to do that, the source talks about these surgical strikes that started around 2020. I imagine these were not popular decisions inside the company.
Oh, far from it. They had to get rid of some sacred cows. The biggest one was probably retiring the Assurance brand in 2020.
I remember Assurance. That was their big bet on competing directly online.
It was, but running two separate direct-to-consumer brands was just inefficient. It diluted their marketing spend, created confusion. So they unified everything under the main Allstate brand, which let them focus all their firepower on one digital funnel.
And it wasn't just branding. They were also trimming the fat from the balance sheet, from their physical footprint.
Absolutely. They sold off their non-core life and health assets, which we'll get into later when we talk about capital. But I think the most symbolic move, the one that really sent a message...
The headquarters.
The sale of the Northbrook headquarters. For a company so steeped in its own history, selling that campus was a physical sign that they were committed to this new, low-cost future. It told the market no expense was off the table.
So the big question, after all that pain, all that effort, did it actually work? What's the metric that proves this wasn't just, corporate PR?
The proof is in the adjusted expense ratio. It's a clean, measurable number. This ratio is basically the cost of selling and servicing their policies relative to the premiums they bring in.
And what did the overhaul do to that ratio?
It successfully dropped it from a very high 24.1% in 2019, all the way down to a much more competitive 21.7% in 2024.
Wow, so a 240 basis point improvement. For anyone not in the weeds of insurance, that 2.4 percentage point drop is massive, isn't it?
It's everything. In P&C insurance, A permanent structural 240 basis point cut to your cost base. Well, that's the entire foundation of the bull case right there. It's this huge efficiency gain that finally lets them start to close the price gap with their rivals without killing their profits.
And this is where the market really had to sit up and take notice, right? The Q3 2025 results. Let's talk about the combined ratio.
The numbers are, frankly, sensational. The overall property-liability combined ratio improved to 80.1% in Q3 2025.
Okay, let's just pause there. An 80.1% combined ratio means what exactly?
It means for every single dollar Allstate collected in premiums that quarter, they only spent about 80 cents on claims and all their operational costs.
So they made almost 20 cents of pure underwriting profit on every dollar.
Pure underwriting profit. Before they even touch their investment income, anything under 100% is profitable, so an 80.1 is truly elite.
And that's a 16.3-point improvement from the year before. The auto segment, which had been their weak spot for years.
The auto segment was the big victory. It hit a combined ratio of 82.0%. That's the proof right there that the huge rate hikes they pushed through have finally caught up to and even surpassed the inflation shock that hurt them so badly from 2021 to 2023.
So you have that dual engine running on all cylinders. You have the restored underwriting profit,
Which is now elite.
and then you have record investment income coming in.
Correct. Net investment income jumped 21.2% in Q3 2025 to almost $1 billion. So you take that 18 to 20 cents of profit on every premium dollar, and you add nearly $1 billion in investment income on top of it. That's how you get to a 34.7% ROE.
But the market's still skeptical. It's pricing in major risks. We have to tackle those head on. What are the big vulnerabilities that are keeping that multiple so low?
Well, the skepticism really comes down to two big structural risks. First and foremost is the homeowner's exposure.
Right.
Allstate is the #2 writer of homeowners insurance in the country. Their brand is incredibly strong there. But that also means they are massively uniquely exposed to catastrophe volatility. It's a risk that a primarily auto carrier like Progressive just doesn't really have to deal with on the same scale.
And there's no shortage of evidence for how volatile that can be.
None at all. Just look at Q1 2025. They had $2.2 billion in net catastrophe losses in a single quarter. Now, they managed this with reinsurance, but the fact that they can retain that much loss in 3 months shows you the inherent risk of the business. It's a constant threat to their earnings and their book value.
Okay, so that's risk number one. What's the second one?
The second is the cost of getting so profitable. I'm talking about the retention challenge.
They had to hike rates aggressively to fix their margins.
Aggressively is an understatement. And when your premium jumps by 30 or 40%, what do?
You shop around.
You shop around. And that's exactly what happened. It hammered their policy and force counts, especially in the core Allstate brand. So the big dilemma for management now is, okay, we fixed the margin problem. How do we pivot back to growing our customer base without giving away all that hard-won discipline? That's the tension the market is pricing in.
So they need to find growth, and they need a sustainable advantage, a moat, in what is a very commoditized industry. Allstate's answer to this seems to be this complex distribution strategy they call the tri-channel approach.
That's right. In this business, your moat is really built on two things: efficiency and customer stickiness. Allstate is trying to be this omni-channel master, which is very different from their competitors.
How so?
Well, you have State Farm, which is almost exclusively captive agents. You have Geico, which is purely direct. Allstate is trying to do it all: exclusive agents, independent agents, and direct to capture every possible customer segment.
But that sounds incredibly complex. You have the expensive legacy agents operating alongside a low-cost direct channel. Doesn't that create a ton of internal conflict?
It definitely introduces complexity, but they see it as a feature, not a gug. It lets them tailor their approach. If a customer wants advice and wants to bundle their policies, the exclusive agent channel is perfect for that.
And that creates stickiness.
High switching costs. But if the customer only cares about the lowest price, the direct channel is there to catch them. If they want to shop around but through one person, the independent agent channel is there.
It's expensive to run, but if they get it right, it makes them more resilient.
Okay, let's break down the pieces. We have to start with the cornerstone, the exclusive agency channel.
Right, the traditional high-touch, high-cost part of the business.
Yeah.
This is still crucial for that high-value customer who bundles home and auto. The value prop is that personal relationship. You don't just leave Allstate, you leave your agent.
But the key development here for an investor isn't growth, it's optimization.
Exactly. They've been consolidating this network. They've gone from over 10,000 exclusive agents down to around 6,000 today.
So they're calling the less productive agencies, trying to get more efficient even in their most expensive channel.
It's a massive efficiency play. They keep the high-touch service for the customers who value it, but they lower the overall fixed costs of supporting a huge, sprawling agent network. The real growth engine, though, seems to be the independent agent channel, which was really kicked into high gear by the National General deal.
That $4 billion acquisition of National General in 2021 was, I think, a stroke of genius. It was transformative. It instantly gave them a huge presence in the $125 billion independent agent market, a place they had always struggled.
So they basically bought a pre-built distribution system.
They did. National General came with deep relationships with over 42,000 independent agents. It was a turnkey solution.
And strategically, it lets them play in a different sandbox than the main Allstate brand.
Exactly. National General is a specialist in non-standard auto insurance. So higher risk drivers, people who need more flexible pricing. It's a segment where they can capture growth and potentially higher margins away from the intense price competition of the standard market.
And is it working?
Oh, the numbers say yes. National General's policies in force grew by a very robust 12% in Q2 2024. That growth was essential to offset the customer losses in the legacy brand while they were fixing the pricing. It's their countercyclical growth engine.
Okay, and that leaves the direct channel, where they're going head-to-head with the likes of Progressive and Geico.
This is their frontier. It's all about the price-sensitive customer. Success here is purely about marketing efficiency. Getting rid of assurance and unifying the brand was huge for them, letting them focus their digital ad spend. They're trying to use their new lower cost structure to finally compete on price.
Beyond just how they sell, the source really emphasizes this other asset, this data mode, built around Arity and AI. This is where they might be able to truly match Progressive's long-held advantage.
In today's insurance world, the company with the most data wins. And Allstate has a unique and powerful asset in Arity, which is their telematics subsidiary. We are talking about an incredible scale of data. They've collected data from over 2 trillion miles of driving.
2 trillion miles. Just put that in perspective. Why is that specific number so important?
Because that volume puts them right up there with Progressive's Snapshot program, which has been the industry gold standard for years. The value is all about precision.
So instead of just pricing based on my age and zip code,
which are just broad proxies for risk, Arity lets them price based on how you actually drive. Your speed, how hard you brake, what time of day you're on the road. This data powers their DriveWise and MileWise programs and allows for hyper-accurate individual-level risk pricing.
and that ability to price risk accurately is the ultimate weapon against adverse selection, isn't it?
It is the single biggest advantage. Adverse selection will kill an insurer. It's when your safe drivers leave because your rates are too high for them, and your risky drivers stay because your rates are too low for them. Arity lets them offer the truly safe drivers the competitive rates they deserve, which keeps them, while making sure the riskier drivers are priced appropriately. It turns data into margin protection.
And it goes beyond pricing. The AI is also about cutting operational costs, which feeds right back into that 240 basis point efficiency gain we talked about.
It creates a real barrier to entry. They're using their Ally AI platform everywhere. By 2025, they said AI was handling 15% of new coding tasks. They also cut down on policy billing inquiries by 45% using automation. This is how they're permanently stripping cost out of the system. It's what makes that expense reduction structural, not just a one-time thing.
Okay, so we've got the operational turnaround, we've got the structural cost advantage. Now the big question is, how do they turn that efficiency into actual growth? They're facing this deep tension between their premium brand and the reality of a price-sensitive market.
That's the crux of it. The brand, "You're in good hands," is a phenomenal trust anchor, especially for homeowners insurance, where people really care about stability and claim service. But in the auto market, which is so competitive.
Trust only gets you so far when the other guy is $500 cheaper.
Exactly. The data shows a persistent premium problem. Allstate's average premiums are just consistently higher than Progressive and Geico.
We're not talking about small differences either.
No. For certain types of customers, the difference can be hundreds of dollars a year. That price gap is why they lost customers when they had to raise rates. People are rational. They'll leave if the value isn't there for the price.
So now that they have this 240 basis point cost advantage, how do they weaponize it to close that gap and stop the bleeding? That brings us to the SAVE program.
The SAVE program shows Allstate customers value every day. is management's big, aggressive bet. They're basically taking the cost savings from their transformation and giving it back to customers in the form of proactive price reductions. This is the pivot from defense to offense.
And this isn't a small trial program. What's the scale of this thing?
It's a massive investment in their customer base. They're proactively cutting premiums for about 10 million customers by 5% or more. For an investor, what this signals is a direct trade-off.
Yeah.
They're willing to give up a little bit of that elite margin they just earned in exchange for stabilizing their customer counts. The bet is that their permanent cost advantage is big enough to let them cut prices and stop the attrition without destroying their target returns.
And this is so critical because, let's be honest, the market share trends have been rough. They've been shrinking to profitability, which, fine, it's a necessary tactic.
But it's not a long-term strategy for growth.
No.
You look at 2024, and the auto market is an oligopoly, and the dynamic was stark. Progressive grew their direct premiums by a jaw-dropping 24.5%.
And Allstate.
Allstate's core auto policies in force declined by 1.4%. They were losing ground to the low-cost players.
So the mission for 2025 and beyond is crystal clear. Pivot back to unit growth, but do it without sacrificing that hard-won margin discipline. This is where their diversified growth vectors become so important.
We've already hit on National General. That is their proven, reliable engine for unit growth. It's capitalizing on that independent agent channel to bring in volume while the core brand stabilizes.
Let's talk about the other one, the one that's high growth and capital light. Protection services. This is the old square trade business.
This is a fantastic diversifier for them. It's all about extended warranties for consumer electronics and things like that. This business did nearly $2 billion in revenue in 2024, and the number of policies has grown 60% since 2019 to 160 million.
So beyond just the revenue, what's the strategic value here?
Two huge benefits. First, it's a very high-margin business that is completely uncorrelated with the P&C cycle.
Meaning a hurricane doesn't break more TVs.
Exactly. A spike in auto claims has zero impact on the profitability of this segment. Second, and this is more subtle, it's a low-cost way to acquire customers. Millions of people get their first touch point with the Allstate brand through a protection plan, which can be a funnel into their core home and auto products later on.
And finally, there's this contrarian bet they're making in homeowners. While everyone else is running away from states like California and Florida,
Allstate is leaning in. They're using their #2 market position and their superior data. The source specifically calls out their advanced wildfire modeling and their reinsurance relationships to price risk that other companies can't or won't take on.
so they're betting their models are just...
They're betting their models let them earn a sufficient margin to justify taking on that risk. And growing the homeowner's book is critical because that home and auto bundle is still the most powerful tool for creating sticky, high-value customers.
Okay, this is the section where the serious investor really needs to pay attention. When earnings jump this fast, you have to immediately start questioning the quality. So let's deconstruct that combined ratio recovery.
Right, and you have to remember how brutal the inflationary shock was after the pandemic. The cost of claims just exploded. Used cars, repairs, everything. It led to a massive underwriting loss for Allstate of $2.2 billion in 2023.
And that loss really exposed the lag in their pricing. The regulators just weren't letting them raise rates fast enough.
Exactly. So the correction they undertook had to be decisive. It had to be aggressive. They pushed through average auto rate increases of 39.2% over a 3-year period.
39.2%. That's an astonishing number for a major carrier.
It is. So that huge profitability surge we saw in Q3 2025, that 82.0% auto combined ratio, that's the validation that the painful medicine worked. But the question is, how do we know the core business is healthier, not just lucky?
Right.
You have to look at the underlying combined ratio, which is the number after you strip out catastrophe losses and one-time reserve changes. And the improvement in that underlying number is the proof. It confirms the expense cuts are real and the rates are now adequate for the current cost of claims. The engine itself is more efficient.
Okay, let's move to that second engine of earnings, the investment income tailwinds. We need to understand why this is a durable benefit, not just a lucky break.
It's not luck at all. It's structural. Allstate has this enormous, conservative $72.6 billion investment portfolio, and it's heavily weighted to fixed income. So as global interest rates rose,
They benefited massively as their old, low-yielding bonds matured, and they could reinvest the cash at much higher rates.
precisely, and you can see the acceleration. Net investment income was up almost 25% in 2024, and then it accelerated again with a 21.2% increase in Q3 2025. We're talking about nearly $4 billion a year in stable, high-quality earnings.
But the key here, the thing that makes it sustainable, is what they did with the portfolio's duration.
Yes, duration management. This is what speaks to sustainability. Management very proactively extended the duration of that fixed income portfolio.
So what does that mean in practical terms for an investor looking at 2026 earnings? Why is extending duration a smart move right now?
It's a brilliant move for stability. As they saw market rates surge, they moved to lock in those higher yields for the long term, 5, 7 years out, before rates potentially start to fall again. By extending duration, they've created this powerful tailwind for their ROE that will continue even if the Fed starts cutting short-term rates. It ensures their average book yield keeps ticking up for years to come.
All right, now for the ultimate test of an insurer's earnings quality, reserve development. This is often buried in the reports, but it tells you everything about how conservative management is being.
It's the truest indicator. And we have to remember, back in 2022, Allstate was reporting adverse reserve development. That was a huge red flag. It meant they had underestimated their claim costs from prior years, which suggested their past earnings might have been overstated.
So now fast forward to Q3 2025, and they report favorable prior year reserve reestimates of $480 million. The skeptical investor has to ask, isn't this just management playing with the levers to make a good quarter look even better? Is this just financial engineering?
That is the right question to ask. It's a high-level, critical question.
Yeah.
And the answer, I think, is in the direction of the change. Yes, reserves can be managed, but the shift from consistently adverse to now favorable development is the strongest possible signal of a genuine recovery in their underwriting confidence.
Explain that. What does favorable development really imply?
It implies that the reserves they set aside for claims in previous periods are actually turning out to be higher than what they need to pay out.
Which suggests.
It suggests that the reserves they are setting aside right now for policies written today are being booked conservatively. They aren't trying to juice current earnings by setting reserves too low. They're building in a margin of safety. They're creating that cookie jar, which, yes, can smooth future earnings, but more importantly, it confirms that management has finally regained confidence in their own risk pricing. That reversal is maybe the most convincing sign that this turnaround is real.
Okay, we know about the huge homeowners exposure. We saw the $2.2 billion cat loss in a single quarter. Earnings volatility is a given, so we have to really scrutinize the reinsurance fortress they've built to manage this.
This is where you test the structural integrity of the whole company. When you have over $5.6 billion in cat losses in a single year like 2023, your entire financial strategy has to be built around transferring that risk effectively.
So let's talk about the scale of their main nationwide program for 2025-2026.
It's a massive defensive wall. It provides coverage for up to $9.5 billion of loss. That's almost double their total cat losses from all of 2023. But the number the investor has to focus on is the retention.
How much they have to eat before the reinsurance kicks in.
Right. And Allstate has to absorb the first $1 billion of loss from each event.
That $1 billion retention, that's the volatility. They could get hit with that multiple times in a bad hurricane season.
And that's exactly why the market puts a discount on the stock. One big event can cause a major earnings hit. Now, they do have smaller, specialized towers, like one for Florida that provides $1.1 billion of coverage above a much lower $30 million retention to protect them from a more localized disaster.
But the really sophisticated piece of this, the part that shows they're thinking about climate risk in a modern way, is the aggregate cover. It's not just about the one big hurricane anymore.
This is so key. The aggregate reinsurance is designed to protect them from the risk of frequency, from all the so-called secondary perils, the hailstorms, the tornadoes, the severe storms that can add up to billions in losses without any single event hitting that huge $1 billion retention.
So how does it work?
Once their cumulative annual losses from all these smaller events add up and exceed $3.5 billion, this coverage kicks in and provides another $325 million of protection.
So it's a cap. It protects their balance sheet from a year of 1,000 cuts, not just one big blow.
Precisely. It puts a cap on their cumulative annual losses, which helps stabilize earnings even in a year with a high frequency of storms.
And they're not just relying on traditional reinsurers either.
No, they're diversifying their risk by going to the capital markets with catastrophe bonds through their Sanders Re vehicle. This lets them lock in multi-year coverage from non-traditional sources like hedge funds and pension funds, which can give them better pricing and more stability.
Let's shift to regulatory friction. This was a huge part of why they lost so much money in 2023.
The conflict was severe. Insurance is regulated state by state, And you had states like California, New York, and New Jersey that were just actively resisting the rate increases Allstate needed to cover soaring claim costs.
And Allstate was basically forced to either lose money in those states or threaten to leave.
Right. So the resolution of that conflict, which they finally achieved through 2023 and 2024, was the single biggest catalyst for the margin recovery in 2025.
They got the rate hikes approved?
They got massive rate approvals, a huge plus 30% in California, for example. It was a major political and regulatory win. The risk, of course, is that this lag always exists. If inflation spikes again, they could get caught in the same squeeze.
Okay, finally in this section, let's look at their shareholder-friendly capital allocation. The timing of their divestitures seems almost perfect.
It was incredibly disciplined. They streamlined the company by selling off their employer voluntary benefits and group health businesses, which generated a combined $3.25 billion in deployable capital.
And they didn't just sit on that cash.
No, the timing was perfect. They sold those non-core assets right as their core P&C business was turning the corner on profitability. And that cash was immediately funneled into their aggressive cannibal strategy, buying back their own stock.
A strategy they've been committed to for a long time.
Since 1995, they've repurchased over $42 billion of their own shares. And right now, they have an active $1.5 billion share repurchase program. They bought back almost $500 million worth in Q2 2025 alone.
And for the critical investor, buying back stock when it's trading at only 2.0x to 2.4x book value, that's a huge signal.
It's a massive vote of confidence from management. They're telling you they believe the intrinsic value is way higher than the current market price, especially when a peer like Progressive trades at nearly 6 times book. They're retiring shares at a deep discount, which mechanically boosts earnings per share for everyone who remains.
And the dividend seems rock solid.
Exceptionally safe. A yield around 1.9%, a very low payout ratio. And they showed their confidence by hiking it 8.7% in early 2025. The whole capital plan is designed to reward the long-term shareholder.
So let's bring it all together. The turnaround is done, profitability is elite, the cost structure is lower, capital return is aggressive, and yet the market is still applying this huge deep value discount.
The valuation gap is really the entire thesis in a nutshell. Even with that 34.7% ROE, Allstate is trading at a PE ratio of somewhere between 6.6 and 7.4x. That's a multiple you usually see on a company the market thinks is in secular decline.
And just to put that in perspective, compare it again to Progressive.
Progressive trades at 12x to 14x PE and nearly 6.0x price to book. Allstate, despite hitting a comparable ROE, is only at 2.0x to 2.4x PB. The market skepticism is just baked into that price. They believe that 80% combined ratio was a one-time fluke.
So this sets up the bull case, what the source calls the coiled spring argument. What's the optimistic scenario?
The coiled spring argument is all about stabilized earnings. The bulls say, look, even if they can't hold that 82% auto combined ratio forever, if Allstate can just maintain a conservative combined ratio in the low 90s, which should be very achievable with their new cost structure, they will generate substantial annual EPS, probably in the $17 to $19 range.
And at a 6.7x PE, a stock earning $18 a share is just.
It's mathematically irrationally cheap.
And there are near-term catalysts to unlock that value.
Absolutely. The $1.5 billion buyback gives you a mechanical lift to EPS just by reducing the share count. But the real potential catalyst is the growth surprise. If that SAVE program works, if it stabilizes their customer base, and you combine that with a continued double-digit growth from National General,
they could actually report positive net policy growth in 2026.
And if they do that, a return to unit growth would almost certainly trigger a significant multiple re-rating. That PE could move from 7x up toward 10x or 12x very quickly.
Of course, we have to play devil's advocate. Let's hear the bear case, the value trap argument. What keeps this stock stuck in the mud?
The bears argue that the 80% combined ratio was an anomaly. It was a perfect storm of mild weather and favorable reserve releases. They believe that intense price competition from Progressive and Geico will inevitably force Allstate's margins right back down toward 95% or higher.
And the catastrophe roulette never goes away. That's the one risk Progressive doesn't have.
Never. The bears say climate risk is only increasing the frequency of severe weather. A truly bad year, with multiple billion-dollar-plus events, could wipe out a huge chunk of book value and prove that the volatility discount is completely justified. And they'd also argue that the slow bleed of market share in the core auto business is a secular trend that National General can only hide for so long.
So this all boils down to 3 core tensions an investor has to resolve.
That's right. First, retention versus rate adequacy. Can they stop the customer decline without giving up all their pricing power? Second, sustainability of margins. Was that sub-90 combined ratio a fluke or the new normal? And third, competitive positioning. Can they actually take share back from the direct players, or are they just destined to be a high-margin, low-growth player in the bundled segment?
But the source material we're working from, it comes down pretty firmly on one side.
It does. The verdict is bullish. The analysis concludes that management has successfully done the hard part. They restored profitability with a permanent cost reduction and proved they can underwrite effectively. They have structural advantages in their data and their distribution that the current 6.7x PE simply does not reflect.
So the primary risk is volatility, but the reward is a significant re-rating if they get the growth pivot right.
That's the trade-off.
So if the market is still pricing Allstate like it's the old, slow legacy insurer, it's completely discounting the value of its most powerful hidden asset, the 2 trillion miles of proprietary driving data in aggregate. So for you, the experienced investor, the ultimate question isn't about the volatility of the past, it's about the efficiency of the future. Does that data advantage, combined with their new lower-cost structure, give them the power to capture growth with the SAVE program, proving that the multiple arbitrage you see today is justified before the rest of the market catches up? That's the calculation.